Well, recently, the global economy has been shaped by monetary policy direction and improving vaccination. The development around the policy direction, especially in the advanced economy, is expected to shape the economic recovery for the remaining part of the year and beyond. But how will this pan out? Akintoye Oyelaku, investment analyst at Cordros Asset Management, joins us now. Good morning, Akintoye. Thank you for joining us. Well, Akintoye, if you can hear me, based on the patterns so far, how do you think what we're seeing in the global economy, with the vaccination improvement and monetary policy direction, how do you see this shaping the global economic recovery?
Yeah, so thank you very much. Since the beginning of the year, we have continued to see growing rate of global vaccination, continue to drive improved sentiment in terms of demand and supply. And we have seen most of this advanced economy have been able to even do better than most of the developing economies, given the fact that we had a lot of fiscal stimulus that was rolled out. In addition to that, we also had the monetary policy authorities maintaining easy stance in a bid to support economic recovery when the COVID-19 induced recession that we saw in 2020. So basically what we are saying is that following the sustained growth in terms of GDP performance and the recovery in terms of level of employment that we have seen so far, we are seeing that the concern is now about inflation. And most of the advanced economies are looking at tapering back or reducing the level of stimulus that has been rolled out to support the economy in order to ensure that the economy's growth is stable and sustainable. So in the last meeting, Jerome Powell of the U.S. Fed stated that they're only anticipating one more employment data before they will start to roll back on the asset buyback program. And investors are starting to price this into the upcoming meeting in November, and they feel that the Fed is going to tighten when it to start reducing the bond purchase program by November, given the fact that a job data will be released before that time. And with what we have seen so far, there has been positive momentum in terms of recovery in job losses. And if you look at the secondary market in the US, we're starting to see reactions from investors. Yields are trending higher. And with the likes of Bank of England and European Central Bank also already sending signals that tapering might begin soon. And we'll likely see this impact the global economy. For instance, the emergence of COVID-19 has led to a lot of fiscal stimulus, which has dragged down yield in the advanced economy. As a result of that, foreign investors have flocked into emerging markets for a competitive return. They wanted more return, knowing that yields are not very attractive at the developed economies. So if yields start to trend higher in the advanced economies due to the policy normalization, we will see that the developing economies will likely want to mirror that decision in the advanced economies. We could see that the developing economies will try to hold down the foreign capital that is within the economy. So they will likely see some tightening in terms of policy rates in order to ensure that their landscape is competitive for foreign investors. And if this will occur, it will lead to some countries that have not yet witnessed significant growth, to suffer for the main part of the year. They might not be able to record much growth as would have been anticipated if the easy stance in the advanced economies persists towards the end of the year.
The pandemic, of course, in early 2020, China's economy has been tipped by many analysts to record one of the strongest economic rebounds. Of recent, the Chinese economy has witnessed persistent power crunch due to the pressures from the short supply of coal. How do you see this impacting the recovery of the Chinese economy for the remaining part of the year? And I mean, aside from that power crunch in China, there has also been a shortage of fuel supply in the United Kingdom. These have in turn buoyed the strengthening of the oil price. Looking at it on a balance of scale, would you consider these developments a positive for Nigeria's economy?
All right. So, firstly, I'll talk about the Chinese economy. So, what we saw within the third quarter was the issue of the Evergrande, which was dominating the headlines, the news headline, given the fact that that sector is really going to affect Chinese economic recovery. And then suddenly we saw that there was also a problem of power crunch, which was due to the global move from fossil fuel to cleaner energy. So this has led to a lot of companies, reducing activities in terms of coal production and made coal production scarce and very expensive. And China generates a large chunk of electricity from coal, and this has greatly impacted the economy. So looking at the impact of the power crunch, is going to cut across in many sectors. Now we are seeing China trying to distribute power supply, ration it in order to ensure that all parts of China get enough power to do their activities. But looking at the fact that the power crunch is going to cut across every other sector, is going to dampen the potential growth for China. Looking at the performance so far, China's economy has recorded one of the strongest growth since the beginning of the year. In the first quarter, they recorded more than 18% growth in GDP. Second quarter, they also recorded a strong 7.9% growth in GDP. But in the third quarter, where we are seeing these kind of issues happening to China, it might tamper the opportunity to ramp up and continue that strong growth that we have seen so far. Nonetheless, China will still likely remain very strong in terms of economic recovery, although we should see that tapering. Already, we are seeing analysts around the world have already started to cut down the projections on China's economic recovery, given the impact that the power crunch is expected to have on the economy. But I mean, if things are resolved quickly, we should see the Chinese economy rebounding, continuing the strong rebound that we have seen so far this year. And coming down to the Nigerian economy, the impact of the power crunch and also fuel scarcity has been a factor. Oil prices has remained very strong. The demand is really strong, although we are starting to see some ramping up of production from the US, which has tapered some of the gains that we saw of recent. Nonetheless, with the winter expected to come soon, it's anticipated that recovery in oil price is going to continue. And, there are even prediction that we're going to see oil touching as high as $90 per barrel. Now, coming to how it affects Nigeria, looking at Nigeria, we always have double impact of increases in oil price. On one hand, increased oil price means a positive impact on the government revenue. We should see growth on government revenue if we're able to ramp up production up to the level that OPEC has permitted, the OPEC Plus cartel. Although Nigeria is still having issues with the maintenance of its structures, this has affected greatly the level of production in terms of oil productivity within the country. But nonetheless, the impact of increasing oil price will be positive for government revenue. It's going to support more revenue generation to be able to finance several projects that government has at hand, and not necessarily the government might not necessarily have to source everything from borrowing. Now, coming down to the other aspect of it is the subsidy removal. So for the subsidy removal, it has been an issue that has been long dated in Nigeria. There's been a lot of there's been a time where subsidy removal was announced, and it didn't go well with the public. We saw a lot of protest and agitation, and I think this has one of the reasons that has been stalling the removal of subsidy removal. Even though removing it will be very beneficial for the economy if we can transfer that fund into other weak sectors like the health sector and the educational sector. And I think in order to reduce this pressure, one thing that could be done is if we could have some kind of investment in long buses that could convey a lot of people at an affordable price. I think consumers will not be very much for that if the subsidy is removed at that time. But without that, we'll likely see a lot of protests from people if that subsidy is removed. And even though the Petroleum Industry Act permits that there should be a subsidy removal, we have seen that the NNPC has postponed any subsidy removal till next year, given the fact that the economy is still recovering. A lot of people have been impacted by COVID-19, and the plan to implement subsidy removal by next year. But I mean, this issue has continued to dominate the headlines, and I think it might likely continue even for the rest of 2022.
All right, Akintoye, a very quick one before I let you go. Let's look at the domestic and financial market as we close the quarter today. How would you rate the performance of the equities and fixed income market so far? And what would be the driver for the remaining part of the year?
Yes, so basically what we saw in the first in the third quarter was a bullish performance across all the market segments. For the equities market, we saw a 4.4% gain in equities market performance, and this was largely due to the earnings season. Between July and August, we saw the strongest growth for the quarter between July and August. In July, we saw the 1.69% growth, while in August, we saw a 1.74% growth. In September, so far, we are still 0.95% growth, and there's still a room for a gain in today's trade. And looking at the sectors that performed the most was the oil and gas sector. As we all know that there has been a lot of recovery in oil price, and compared to the base effect, for most oil companies in Nigeria, they have seen a lot of strong rebound. Given the fact that in most part of the 2020 period, they suffered from the economic shutdown or the lockdown, which reduced consumption of fossil fuel, even across the world. So we have seen a lot of demand in that aspect, and it has continued to drive sentiment for investors since the beginning of the year. So the oil and gas index gained 70.4%. We also saw gains in the banking sector and also the industrial goods. The banking sector advanced marginally by 0.7%, although that's also due to the corporate earnings release. Although the sentiment has been mixed in the banking sector, we saw some strong performances in some sector, while other sectors, some companies, while other companies recorded very poor performance. So we saw that sentiment was mixed in the banking sector. For the industrial goods, this was badly moved by.
Okay.
All right.
Time is really not our friend, but we do appreciate your time. And I'm sure you're really getting ready to go on a holiday, October 1, right? Okay. Thank you very much for your time. We do appreciate it.